Today, we are diving into a topic that's got everyone scratching their heads: the anticipated resurgence of Canada's housing market in 2025. Yes, you heard that right. Despite a sluggish economy, the rising unemployment, and experts are forecasting a 5 to 8% increase in home prices and a 25% surge in home sales next year. Let's unpack this paradox, shall we? Let's set the stage first. According to Remax, Canada's 2025 housing market outlook, home sales are expected to rise in 33 out of 37 Canadian regions, with the national average residential price projected to increase by 5%. But hold on a second. Aren't we in the midst of an economic slowdown? Unemployment is on the rise, 6.8 as per the last figure, and the RBC is expecting to hit 7% sometime in January or February. And consumer confidence isn't exactly soaring. So what's fueling this bullish outlook on housing? Welcome to the concept of financial repression. It's when governments implement policies to channel funds to themselves that in a deregulated market would go elsewhere. This often involves measures like keeping interest rates artificially low and creating a captive domestic audience for government debt. So, if I'm the government, I'm looking at, a lot of Canadians are investing into Bitcoin and other cryptocurrencies, putting money into S&P 500, NASDAQ, mainly outside Canada, right? So, if I'm Canadian government, I might be thinking, how can I keep this capital in Canada? What do I have? My TSX index isn't that attractive. So what do I have? Real estate. On the side effects of financial repression is currency debasement. Essentially, reducing the value of the currency to manage government debt. This can lead to higher inflation, which in turn inflates asset prices, including real estate. But why is financial repression is the only option for Canada? Well, it's not just for Canada alone. It's basically across all Western economies. Look around Europe, UK, US, and Canada and Australia as well. So let's break it down. Falling birth rates and recent cuts to immigration target mean slower population growth, which directly translates into weaker economic expansion. Weak economic growth leads to lower tax revenues, widening fiscal deficits, and putting more pressure on the government to borrow. So we are back to square one. So we have had this falling birth rate issue across Western economies. The recent birth rate in Canada is 1.26 kids per woman. And in order to sustain economies, you have to have at least 2.5 kids per woman birth rate, at least. So the population is shrinking, and this gap was being filled by immigration influx. Now the government is cutting it back because of the backlash, from the communities. So when you don't have population growth, you cannot project economic growth because of that, and you don't have productivity growth, which will drive the economic growth outside of the population growth. Why? Because the debt is too much. When you pay interest on your debt more than your defense budget, your debt is too much to sustain any economic growth. So your debt interest payments is eating pretty much all of your resources. So what options do you have to reduce that debt? You cannot lay off all the government workers, right? It's not really practically possible. So what you're going to do is to print more money and print those devalued dollars to pay off the debt. That's what we call financial repression. Now the government could choose austerity to balance the books. Cut spending, raising taxes, tighten belts. But let's be real. Which political class wants to swallow that bitter pill? Whether it's Trump south of the border or Poilievre eyeing Ottawa, nobody wants to run on a campaign of fiscal pain. So what's left? Money printing. And here's the kicker. When you print more money to finance deficits, you devalue currency. The devalued currency leads to inflation, and inflation boosts asset prices. Housing becomes the biggest beneficiary because of real estate is seen as quote-unquote inflation hedge. Housing is also one of the biggest revenue generator for Canadian government. When you look at the cost of the new build construction, 30% of that goes to government pockets. Permit fees, taxes, levies, all of that stuff, 30% of every new build goes to government. So housing has been the engine for tax collection for the government. So they don't want this to collapse or reduce in any shape or form. So they want to fuel this back into the growth. So while everyday Canadians are worried about putting food on the table, housing market seems to defy gravity, propped up by the cheap credit and rising money supply. But at what cost? Savings get eroded, wages cannot keep up, and the wealth gap widens. Now let's shift our focus to housing starts, the initiation of new residential construction projects, which play a crucial role in determining future housing supply. Recent data indicates a nuanced picture across Canada, particularly in Ontario. Back in November 2024, Canadian housing starts increased by 8% month over month to an annualized rate of 262,400 units across the country, making the highest level since July. This uptake was broad-based, with urban multi-unit starts rising by 11% and single detached starts by 4%. However, Ontario, the biggest province, tells a different story. The province experienced a decline of approximately 5,200 units, bringing starts down to 59,400 units in November. This represents a significant year-over-year decrease, with October 2024 figures showing a 35% drop compared to the same period in 2023. So Ontario is your biggest province. This is where all the major population growth is happening. This is where all the business activity is happening. This is where we need a lot of housing, and we are seeing a decline of housing starts, which means the current pipeline is okay, but there's nothing new coming into the pipeline, which means the future supply of 3-4 years down the road, it's not there. So this decline in housing starts, especially in a populous province like Ontario, raises concern about future housing supply. Fewer new constructions today mean a tighter housing market tomorrow, potentially exacerbating affordability issues and fueling further price increases. Several factors contribute to this downturn in housing starts, including economic uncertainties, rising construction costs, regulatory challenges. Notably, the Ontario government has set an ambitious goal of building at least 1.5 million homes by 2031. Achieving these targets appears increasingly challenging amid the current slowdown. If you look at the financing of these projects, that becomes non-viable when you have higher interest cost and you have lower demand from the immigration side of things and also declining rents. The match simply doesn't work. So let's get this straight. In a time when the average Canadian is tightening their belt, this housing market is set to boom, at least per the mainstream media. It's almost as if the laws of economics have taken a holiday, eh? But before we pop up the champagne, let's consider the long-term implications. Artificially inflating asset prices can lead to bubbles, and we all know what happens when the bubble bursts. And we know that because of the financial depression, the bubble creation is inevitable. And it's not just housing. Every asset will see an influx of capital, because when you see your money is getting depreciated significantly because of the government debt financing, you will see all the hard assets, Bitcoin, stocks, real estate, and gold and silver is going to fly off the shelf. So what's next? Well, we will see the asset appreciation continue to go up while the currency is going to lose power, the purchasing power. I know that the bears will say, oh, this is BS. We are going through a recession, even a depression, a silent depression where people will not have jobs to sustain these houses. Yes, maybe a certain percentage, but remember, it's the wealthy owns the asset. The middle and poor class will struggle. They will continue to struggle because for them, it's a depression. When you don't have economic growth and your wages are stagnant, your expenses are going through the roof, for you, it's a depression. But for someone who owns multiple assets, their assets has been appreciated multiple folds in the last 4 years. For them, it's a boom time. So we cannot control this, but all we can do is to understand these cycles and adjust our portfolio accordingly so that we can be on the other side and protect our finances going forward. Anyway, if you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. Take care. Financial education is very important for everybody, especially for the kids who are still at school, because when they grow up and go into the professional lives, if they don't know how to manage their finances, that is going to be a disaster to begin with. I have just published an ebook for the kids aging between 10 and 16 years to understand how they can manage their finances. So when they grow up, they know exactly how to manage their personal finances, because I have broken it down at a very, very basic level. What is money? How can we save? How can we invest? What is debt? How can we use debt? What is credit card? And how we can set ourselves for the financial future when we go into our professional life. So if you are a parent looking for a very simple to use ebook for your kids, click the link below to order the copy for your kids, and let me know what you think about that. Let's get back to the video. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and it allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.